Hey everyone, me Kevin here. We need to talk about the Fed because the Fed could literally destroy the market. Well, you might be watching this tomorrow, so I should say the date. On Wednesday, March 17th, which is almost 1 year to the date, almost the bottom of the market. March 23rd of 2020, when the market was totally in the big old doldrums. And things weren't pretty good on March 17th last year either, okay? Because March 16th was one heck of a sell-off. But the point is, the Federal Reserve could do some serious damage to markets tomorrow, and I'm not happy about it, and I'm not very enthusiastic. There is a reason why I have not sent a single frickin' buy alert to my course members in the Stocks and Psychology and Money group in 7 days now, which is a long period of time for me not to buy stocks. It's because I'm loading up on that cash, because the Fed could be pretty nasty tomorrow. There are two big catalysts that we're looking for tomorrow. All right, let me first explain details here as well. The Federal Reserve Chairman Jerome Powell will be speaking at 2:30 p.m. on March 17th, and he will be discussing the outcome of the two-day policy meeting, the FOMC, Federal Open Market Committee policy meeting, essentially. They'll be discussing the results of those. Federal Reserve Chairman Jerome Powell will give a prepared statement, and then he will answer questions for about 45 minutes. What Jerome Powell says or does not say during this discussion and initial speech will not only be picked apart word for word, but could make or break the market tomorrow. And the market's already very tenuous, and we saw that today here on the 16th. We saw a lot of tenuousness in stocks. And I mean, look, we had a good open, but after the first hour here on Tuesday, the market just started selling off because it's like, wait a minute, tomorrow's Fed day. It's almost like the suits woke up and they're like, oh yeah, the stocks are doing good. Jerome Powell speaking tomorrow? Sell everything! Like seriously, like it used to be, don't fight the Fed. Jerome Powell, this savior, is coming out to speak. Now it's bad. And it's all bad because of what happened last time around. And that was when Jerome Powell spoke a couple Thursdays ago on an interview, and he was asked, hey, bond yields just skyrocketed. They shot up at the fastest velocity we have seen bond yields go up in over 10 years. What are you going to do about it, Mr. Powell? And remember, the stock market's like, dude, you've been here for us every day so far. You keep bailing us out. Like, what are you going to do for us this time? We're worried about inflation coming. Like, please assuage our fears of this inflation coming. And Jerome Powell's like, everything appears to be operating normally here. We want inflation. We're trying to get interest rates up. We're trying to get rates to 2%. We're trying to get inflation to 2.5%. We're not planning on doing anything now, but I mean, look, if bond yields are going up because they think there's going to be inflation, cool. Sweet. I'll write that off my list. Success. And the stock market lost it. Lost it. I mean, we had the bloodiest Thursday and Friday in this crash that we had over the last month here because of Powell. Now, obviously, we could say we've had the greatest run in over a year because of Powell and the money printer. But what Jerome Powell says or does not say tomorrow is going to potentially amplify in either direction what happens. Now, I have expectations, and we'll talk about those expectations, but let's make the two catalysts very simple. Catalyst number one is Jerome Powell making a statement about anything that could affect yields. If Jerome Powell says, hey, standard leverage ratio or standard liquidity ratio over the banks, we'll go ahead and extend that. We'll let the banks have less money on hand. And you know what? We'll just extend the CARES Act program that expires at the end of this month, which lets banks have less cash on hand so that they have more money for potential losses or issues that come up. If Fed Chairman Jerome Powell says, hey, we're cool with you having less cash on hand, that means banks could potentially buy more bonds, yields come down, market's happy. If we see any kind of yield curve control where the Fed says, you know, we're going to start buying some longer term bonds. We're going to buy, instead of maybe 10 years, we're going to buy some more 20, 30 yields. That has the effect of pushing down long-term rates, which is a form of yield curve control. The market's going to cheer that. The market is going to cheer anything that implies additional liquidity or lower rates. That will be very, very good for the stock market. It certainly will be very, very good for tech stocks. Unfortunately, I don't think that's going to happen. Now, there is a second catalyst, but let me finish the thought here on problem, or catalyst, I should say, number one, and give my opinion on it. On catalyst number one, I don't expect catalyst number one going any differently from what we had 2 weeks ago. And that was Fed Chair Jerome Powell going, look, money's flowing. Markets are working. If yields are going up, we don't see a problem with that. Or if yields are going up, we don't see a problem with that. In fact, if we think inflation is getting out of hand or something, we'll do something about that. But we don't think there's going to be inflation. We think we're going to have temporary spikes due to base effects comparing to a year ago, and temporary spikes due to a reopening, but we think those will be transitory in nature, he'll say. He'll say we don't see persistent inflation happening. We think money markets and liquidity is operating as intended. We don't think the banks need to have these low reserves anymore because they're writing off less losses. I mean, this was something I just covered on last. Look at this. Look at this. You think the Fed is going to be nice to the banks after this on page 1 of the Wall Street Journal? Come on, folks. Banks eye cash reserves for profits. U.S. banks are sitting on a pile of cash that could turn into billions of dollars of profits. You think Jerome Powell is waking up on Tuesday going, the banks need help? No! My expectation is not good for tomorrow, when Chair Powell talks, because Chair Powell is not going to give the market what the market wants. The market wants some more cheap stimmy. It wants some more printed money. Let's go. Come on, just one more hit. Just one more hit. Come on, please, one more hit. It's what the market wants. The market's not going to get it tomorrow. And that's why we started selling off today. I really believe that Fed Chair Jerome Powell is literally going to do nothing. He's going to let this bank thing expire. He might not even address it. I think he's going to get asked about it. And if he gets asked about it, I wouldn't be surprised if he just blows it off and says, we haven't determined yet. That's going to be a blow off. It's going to be like March 30th and they're just going to let it expire. I wouldn't be shocked. They'll just kind of let this bond thing play out, and then they'll just let that bank SLR expire. Wouldn't shock me whatsoever. I mean, that's what I would do if I were Chair Powell and I were reading this stuff in the Wall Street Journal and probably doing research to reiterate the same thing. And it's true, banks didn't lose as much money as they thought they would lose. So they got plenty more cash. They set us a bunch of money aside for a rainy day, and they didn't need it. So I don't think banks are going to be happy, and I think everybody's kind of expecting that. I don't think they're going to institute any kind of yield curve controls because what is happening with bond yields going up is literally what the Fed wants. They want this. This is good for them. And the auctions are going fine. There was a panic initially with how quickly the yields went up, but the auctions are going fine. There's enough balance. The supply and demand is right. The Fed doesn't have to change anything. So, not expecting change. It's just going to be bad for tech. Oh well, maybe it'd be a buying opportunity again. The second catalyst, okay, and this is potentially a bigger one because we already have this strong expectation from the last time Jerome spoke that nothing's going to happen. Okay, so what's the second possible thing? What else could Fed Chair screw up tomorrow? Sorry, I don't want to come across as too blunt, but oh well, I am. Something called the Summary of Economic Projections, the SEP. Notice what it says here, for release at 2 p.m. Eastern Time, December 16th, 2020. This is what the Fed does. When they release these, they have these documents embargoed until exactly 2 p.m. Well, we got one coming up tomorrow, which you might be watching this on the 17th, so today, at 2 p.m. Eastern Time. It's the same thing. And they are on time. These people are sharp. This is not like Biden or Trump taking 30 minutes to show up because both of them are late all the frickin' time to their events. This stuff shows up on time. They're on point. And there are two very important pages that we have to look at. Page of importance number 1 is the change between the last summary of economic projections and the next one. So for example, what we're looking for is any kind of change that could signal the Fed is interested in moving rates higher. Let's go ahead and just erase all this jibber jabber that I wrote on here from the last time. Let's grab a little highlighter here and let's do a little bit of highlighting. So this summary of economic projections here from December indicates that the Fed believes we will have GDP growth of 4.2% and that we will end up in 2024 plus with 1.8% growth. If the Fed increases their projection, if this number goes up, then it's possible the Fed's thinking, oh, the economy's doing much better than expected, which is something I do think the Fed is going to do. And that number goes to 4.5 or 5% or 6%, people are going to perceive that as, oh, Fed thinks growth is coming back faster. That means they're going to increase interest rates faster. It's that simple. And the market's going to sell off. It already is because of this expectation. If the unemployment rate is expected to be below 5% in 2021, it's going to change expectations. I think the market might sell off, especially tech again. If we see the unemployment rate in 2022 go under 4%, oh, you better believe when that unemployment rate goes under 4%, people are going to think that's it, the Fed's raising rates sooner. And tapering. Remember, there are two things the Fed could likely do. They could begin tapering their bond purchases sooner, and then they'll eventually raise rates. And the stock market doesn't like the idea of that. Even though this is all a bunch of bullcrap, short-term crap thinking, it's not like I want to sell out of the market and not be in the market and not be participating in the market just because, over time yields are going to go up again and interest rates are going to go up again. I don't care. Bring it on. I'm still going to invest in Train America. But anyway, inflation going up, GDP going up, the unemployment rate going up, and certainly inflation expectations, which the Fed's measure is the PCE here, any kind of increase in these figures here is absolutely going to make people nervous that, the Fed's going to taper sooner, and then interest rates are going to go up. So this is a very, 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 certainly over here, but we're not going to see any change down here. They're not going to clearly signal, oh yeah, we think interest rates are going to go up. It's just, I don't expect to see any change down here. The biggest changes we see are really going to be in this box right here. So you got to look for this page, Table 1, Economic Projections of the Fed Reserve Board. Very, very important. And keep this in mind, my timeline. This is Kevin's timeline. Okay, now, and I believe between now and rates going up is 18 months. But now gets delayed by the start of taper. So let me explain that. The day the Fed starts tapering bonds, the day they say, hey, instead of buying $120 billion in bonds every month, we're going to buy $100 billion. We're going to put less money into the market. We're going to print less money. Then we're going to go to $80 billion. Then we're going to go to $60 billion. The day that happens, I think we are 18 months away from rates going up. Now, the Fed has told us, they will tell us, quote, and they're going to say this again tomorrow. They have told us regularly, we will tell you well in advance of any kind of tapering. So I don't actually think tapering is going to happen tomorrow, which would start that 18-month clock where maybe we see rates go up in 22. I don't see that. But a way that the Fed can start signaling things to us is this table, folks. This table right here, this is where the money is right here. That's going to be a big change. The next thing we're going to look at is we're going to look for the dot plot right here. And so this dot plot says that these are sort of people on the board at the Federal Reserve, and they get to determine, hey, what do we think rates are going to be in the future? So what's kind of cool here is you can add these up, right? Now 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. So you got 16 dots here. And everywhere there's a dot, it says, oh, okay, so 2 people think rates should be 3% in the long run. It just says longer run, which is really 2024 plus, right? 2 people think that, 1 person thinks 2.75, a bunch of people think 2.5, and 1 person thinks 2.0, right? So pretty much everyone's pretty heavy on being at that 2.5 level. But look at this, you've actually got 1 member saying, no, we should raise rates in 2022, and you've got 5 members who say, no, we should raise rates in 2023. If all of a sudden this gets a whole lot more crowded, and this could spook the market, and we start seeing something like, we start seeing something like this here, doop, 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 and then let's go ahead and jump in here, and we'll take out the little 3 dots that we had over here. There we go. So we start seeing something like that, you better believe the market's gonna go, whoa. It's not even pretty. There's a reason I haven't bought stocks in over a week. This is the dark time. Now, look, if the Fed surprises us and we don't get nastier expectations, we don't get, we get the constant reassurance that everything's okay, we're not going to taper for a long time, we're not worried about inflation, our projections haven't changed, our dot plot hasn't changed, the market might do okay. I think it'd be flat to a little bit positive. I think the market would skyrocket if the Fed came out and said, oh, banks, we're going to give you more, more latitude to have more cash. We're going to print more money and buy more bonds, or we're going to do yield curve controls. If that happens, the market will skyrocket, in my opinion. I think we get a skyrocket. But I think there's like a 10% chance of a skyrocket. In fact, let's go on record here, something that a lot of people do not like doing, but I don't care. It's what I think. And that's why I think you come to this channel. I think there's a 10% chance of a shocker. Excuse me. Market skyrockets. I think there's an, we'll say 65%. Is that fair? No, I'm not that. No, the next two are pretty close, okay? So I'm going to go, let's go to the worst case scenario here. Like really good projections and a big rate increase here, right? So big crash like last week, or this is really like 2 weeks ago, right? So 2 weeks ago, fine. Crash like 2 weeks ago. Let's give that a 35% chance of happening. That means I think there's a 55% chance of just a flat and soft market after Jerome speaks today. Or, well, whenever you're watching this, on the 17th. So those are my thoughts, and we know what to look for. So we know what to look for. We know these thoughts. What am I doing with money? I'm building up as much cash as freakingly possible to keep margin as low as possible. I'm at about 30.1% right now. Obviously, if stocks go up, my margin outstanding goes down, which would be great. But I'm not going to rely on that. So I'll have to really see a sweet opportunity to go buying. Now, if we get a crash, that 35% thing happens, and we get a big sell-off again, Tesla goes under 600 again, you know what I'm doing. And I might actually add to some opportunities then too. I might add a few new stocks that I want to get into, but I would have to, I'll wait for a discount to get into those. I'm certainly not going to get into something that's up substantially, and the Fed's behaving the way it is right now. So I'm going to be a little more cautious because these next 3 months could be problematic. So keep that in mind. If you want more of my sort of guidance, psychology, thoughts, and opinions, I feel like I do some form of a discussion like this regularly with course members. Almost every day in the live stream, I give sort of a summary of here's my feeling today. This is what I think is going on in the market. Check out that coupon code. We extended it for a few days just to make sure people with stimulus checks can get in. There were so many requests for that. Get 38% off. Use that coupon code HODL. And folks, see you in the next video. Thanks for watching.